Hi guys, welcome to my channel. Imagine you are managing a portfolio during a calm market period. Stock return move wildly, volatility is low, then suddenly a crisis happens. Market crash, price move dramatically, and after the crisis, volatility slowly decreases again. The pattern appears constantly in financial market. Large shock create large uncertainty, while period create low uncertainty. But traditional regression model often assume volatility is stable over time. So, how do professional analysts handle changing volatility? Yes, they use models such as ARCH, autoregressive conditional heteroscedasticity. In these lessons, we will explore how ARCH models forecast volatilities, how economists deal with non-stationary relationships to rule conflagrations, and how professionals choose the right time series model for investment analysts. Let's start with one of the most important realities of financial markets. Volatility is not constant. A common assumption in regression analysis is that the variance of the error term remains stable, but financial data often violates these assumptions. Think about stock returns. During normal periods, daily return may move within a narrow range. Then a major event happens, a financial crisis, a geopolitical shock, a central bank surprise. Suddenly, returns become more volatile. Afterward, volatility gradually decline. This pattern is called volatility clustering. Large changes tend to be followed by large changes, and small changes tend to be followed by small changes. This is where ARCH models become useful. So, ARCH stands for autoregressive conditional heteroscedasticity. Let's break down the name. Autoregressive means the current value depends on the past value. Conditional means we are conditioning today's expectations on previous informations. Heteroscedasticity means the variance changes over time. Put everything together, ARCH means today's volatility depends on past volatilities. So, in other words, the uncertainty we observe today is influenced by previous shocks. This is extremely important in finance because investors care not only about expected returns but also risks. The simplest ARCH model is ARCH1. The equations is this. The intuition is straightforward. Today's square error depends on yesterday's square error. Why square error? Because variance measure the size of fluctuations, not their directions. A positive shock and a negative shock can both increase volatility, so we focus on magnitude. The key coefficient is alpha 1. If alpha 1 is statistically different from 0, past volatility helps explain current volatility. That means ARCH exists. So to test whether ARCH exists, analysts use a simple hypothesis test. A known hypothesis is x0 alpha 1 equals 0, meaning there's no ARCH effect. Past shocks do not influence current variance. The alternative hypothesis is alpha 1 different from 0, meaning ARCH exists. This is the formula of the test statistic. If the absolute value of the test statistic is the critical value, we reject the null hypothesis. So the time series has conditional heteroscedasticity. So once ARCH exists, we can use the model to forecast future volatility. The 1 period ahead variance forecast formula is here. The interpretation is powerful. If yesterday's shocks were large, today predict volatility increase. If yesterday were calm, future volatility is expected to remain lower. This is exactly how risk managers think. They are not only asked what returns should we expect, they are asking how uncertain is that returns. So, why do ARCH matter statistically? Because ordinary least square assume constant variance. When variance changes over time, the standard errors of regressions coefficients become unreliable. That means hypotheses that may be misleading. A coefficient may appear statistically significant when it is not. or the opposite. To correct these problems, analysts can use the methods such as generalized least square or GLS. The objective is to adjust the estimation process so that statistical inference becomes reliable again. Now let's move to another important time series problem. Sometimes two variables are individually non-stationary, but they move together in a stable economic relationship. This is called contegrations. Think about oil price and energy company profits, or interest rate and bond price. Two variables may trend over time, but the relationship between them remains stable. That long-run connections is contegrations. So to test contegrations, we first estimate YT. Then examine the residuals. The key question is, are the residual stationary? If the residual have a unit root, the relationship is not stable. The variables simply move together by coincidence. But if the residual are stationary, the two variables share a stable long-term relationship. That means the regression's relationship is meaningful. So now let's combine everything into a professional workflow. When analysts face a time series problems, they do not immediately run a regressions. They follow a structured process. Step 1. Define the objective. Are we modeling relationship between variables or forecasting the variable over time? The goal determines the model. Step 2. Plot the data. Look for trends, seasonality, structural change. Visual inspections come first. Okay, so step 3. Check stationarity. If the series is non-stationary, transform it. Example, linear trend, use first difference. Exponential trend, use logarithm and first difference. Structural change, estimate separate model. Seasonality, include seasonal lag. Okay, so step 4, build an AR model. Start simple, usually AR1, then examine residual autocorrelations. If residual pattern remain, add additional lags. Step 5, check for the IRCH. Regress square residual on last square residuals. If art exists, adjust the estimations method. And the last, step 6, compare forecasting ability. Use out of sample RMSE. The model with lower RMSE generally provide better future predictions. Once you understand the principle, time series model become much more than equations. They become tools for understanding risk, forecasting uncertainty, and making better investment decisions. Thanks for watching.